Good morning, dear learners, and welcome you all to the next lecture of my course on financial literacy. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you all to the module number 9, Concepts Related with Income Tax Return, and lecture number 44, Post Office Saving Schemes. In the previous lectures of this particular module, we had discussed about some tax saving schemes that have been discussed under the Income Tax Act of the section 80C. Here also we will be going to discuss the different type of saving schemes that are announced by the post office of country for the purpose of tax saving, as well as giving a chance to the lower income group and middle income group to save their money into the various schemes of the government backed financial schemes. So basically these investment schemes can help the individuals in saving their amount into different type of schemes that can give them a stable and regular return, as well as it can also help them to minimize their tax burden at the time of income tax return filing by claiming the deductions for investing into these schemes of the post office. So in this lecture, we'll be going to discuss about the various post office saving schemes, that is the Sukanya samriddhi yojana or the time deposit account of the post office, as well as we'll be going to discuss about the various types of document that are required for the purpose of opening the account under the post office schemes. We'll be also going to discuss about the different types of other post office schemes as well as the time deposit account scheme, its key features, its eligibility, the various types of criteria that needs to be fulfilled by an individual to open the account under the post office saving schemes, and the minimum amount of deposits required. And we will be also discussing that who are the different categories of individuals that are not allowed to open their account under the post office schemes, and will be also going to understand the tax benefit and the process of opening account with the help of the post offices. So in the previous lectures of our course, we had discussed the various types of investment avenues that are allowed under the section 80C for claiming the deduction for the purpose of calculating the total taxable income of an assessee. Here we are going to discuss one more type of investment that can help the small income group and middle income group people for the purpose of investing their money into the short term as well as the long term saving schemes that are announced by the post offices of the country for minimizing their tax burden and also having a constant and regular source of income with the help of investment of their money. So basically, post office saving schemes are those types of schemes that allows an individual to open an account into the post offices of the country. These are most popular and widely used kind of investment that is used by the small and lower income level investors in the country, because it is considered as a risk-free investment. So here the risk that is involved into the investment procedure is very low, and that is why it becomes a suitable option for all the income earners who belong to the lower level income group and middle level income group. As well as it also offers guaranteed return on the investment, and it also gives a guarantee of the repayment of the principal amount of the investment, as this scheme is backed by the government of India. So there are different kind of post office saving schemes that may be available to an individual, such as Public Provident Fund PPF that we had discussed in the previous lecture, post office saving deposit account that is similar to a bank saving account number, post office time deposit account, as well as senior citizen saving schemes account, and Sukanya samriddhi account is also an option of investment into the post office saving schemes. So with the help of investing your money into these different type of investment avenues, you can very efficiently invest your money for a longer period of time, as well as you can also claim some tax deduction and maximize your savings and investment. So let us understand first what are the various documents that are required by an individual for the purpose of opening the post office saving schemes. So the various post office saving schemes that we had discussed in the previous slides, such as public provident fund, then time deposit account of the post office saving schemes, and saving account scheme of the post office saving scheme, and Sukanya samriddhi account. For opening all these different types of schemes into the post offices, you need to have these different documents that have been discussed here. So first you need to take a account opening form from the post office for opening your account into these different schemes. So depending on your choice of investment, you can ask post office to give you any kind of application form that is required for opening your account into these different schemes that we have discussed. After that, you may be required to fulfill the various KYC documentation procedure. In the KYC form, if you are a new customer, you need to provide with all the details such as personal details, date of birth, as well as residential address, then your PAN account number and different other information. Whereas if you are an existing account holder of the post office schemes, in such cases only modification in the KYC details are required to be filled by the individual to open a new account. After that, you may be asked to provide the PAN card, that is the permanent account number, that is issued by the income tax authorities of the country to every citizen who files return of their income as per the rules given by the Income Tax Act 1961. So PAN card is basically a account number that helps the income tax authority and the government of India to have an access of all the accounting and transactional details, as well as the estimate of the income and expenditure that a person may be having in a financial year. So all the bank account, all the post office saving account and the other accounts are linked with the help of the PAN number, so as to identify all the transactions that are done by an individual for the purpose of expending or investing their money into the market. Then you need to provide the Aadhaar card. If Aadhaar card is not made available, in such cases you can provide some other documents as well to the post office, such as you can give your passport, your driving license, your voter ID card, your job card that is issued by the Manrega, that may be signed by the state government officers, or any kind of letter that is issued by the National Population Register that may contain the details of your name, your address, as well as your proof of date of birth, and birth certificate may also be asked to submitted by the post office for the purpose of opening any kind of account under the schemes of the post office. In case if you are a minor, in such cases birth certificate may also be asked to be submitted. So these are the documentation that are required. You need to fill up an account opening form, you need to fill all the KYC details, you need to give your PAN card details, your Aadhaar card details. In the absence of your Aadhaar card detail, you may be asked to provide passport, driving license, voter ID card, job card issued by Manrega, or you may also give letter issued by the National Population Register and your details that may be your name and address and date of birth provided in the job card. So these are the various details that are required. The various benefits. Now let us understand why one should opt the post office saving scheme for the purpose of investment. We had discussed some of the other financial avenues also in which you can invest your money, and you can also claim the deduction, as well as you can invest your money for a longer period of time and you can have wealth accumulation also. Then what are the other benefits in the post office saving scheme, so that you may choose over the other financial instrument, the post office schemes? So the basic benefits are: it is safe and secure. That means a post office saving account basically offers you a secure way to invest your amount into the various schemes that are backed by the government of India. So this makes it very good choice, a very suitable option for the investment for all the investors who are of risk averse nature. That means those investors who do not want to take risk for investing their money into the financial market, they can take the option of post office saving scheme. They can minimize their risk involved into the investment procedure, as well as they can have a regular source of return also. After that, it gives you a guaranteed return. That means investment in post office saving schemes offer you a stable source of income in the form of interest. So this is a government backed scheme, so there will be no option where your interest will not be paid to you. So a constant and stable regular amount of interest is paid to the account holder for saving their money into the post office schemes. Next is the tax advantage. As we have discussed, it gives us a chance to claim the deduction as mentioned under the section 80C of the Income Tax Act. So if you invest an amount of up to rupees 1,50,000 rupees in any of the schemes of the post office, then you can claim the deduction of a maximum limit of 1,50,000 rupees per annum as per the section 80C of the Income Tax Act 1961. Now, the next one is the easy investment procedure. So, investing into a post office saving scheme is very easy and very simple. So, for all the investors who do not know the complexities of financial market, who do not have the financial knowledge and experience, they can also invest their money into the post office saving scheme by simply filling out the application form for opening a time deposit account or a saving account, or opening a Sukanya samriddhi account into the post office saving scheme. So the procedure is very straightforward and it involves no complex steps to complete for the purpose of investing your money. So it is suitable for all those investors who are not having good knowledge of the financial market and expertise, as well as they also want their money to be safe and secure, and they want a regular source of income by their investment. So these are the various benefits of the post office saving accounts. Now, let us understand the different categories of the post office saving accounts or the schemes that are offered by the post offices. So, these are the Sukanya samriddhi account, time deposit account, or the saving bank account, or one of the account we have already discussed in the previous lecture, that is the PPF account, that is also offered by the post office of the country. So, the first one is Sukanya samriddhi yojana. The Sukanya Samriddhi Yojana is basically a flagship scheme that has been launched by the government of India in the January 22 in the year 2015 under the Beti Bachao Beti Padhao initiative of the government of India. This scheme basically aims at combating the gender discrimination in the nation, and it also helps to reduce or manage the financial burden of a girl girl's child education and their marriage on their parents or guardians. So basically, this particular flagship program of the Government of India has helped the individual investors to make their girl child future much more secure, as well as their education can also be managed well in advance with the help of Sukanya Samriddhi Yojana account. So the basic objective of these scheme was to reduce the gender discrimination in the country and to promote a habit of encouraging the girl child parent to invest into this scheme so as to secure financially the future of their girl child. The next objective is to help the parent to accumulate the funds for their daughter's education as well as for their marriage until she turns 18. So at the time of the birth of the girl child, the parent, they can decide whether they want to open the account or not, and when she is of the age of 3, they can start investing into the Sukanya Samriddhi Yojana account, and up to the age of 18 they need to invest into the scheme and they can withdraw the money at various stages for the education as well as for the marriage purpose of their daughter. So it also helps to promote the gender equality in the nation by guaranteeing the education and the well planned financial future for the girl child of their parents. So the various benefits of the Sukanya Samriddhi Yojana is that they are government backed schemes, so there is no chance of losing your principal amount of investment into the investment avenue. You will be going to have a constant as well as a regular income on the amount invested into the Sukanya Samriddhi Yojana, as well as it helps in planning the various financial expenses that may be required to finance the marriage expenses of the girl child. So it helps in supporting the financial expenditures required in the marriage of the girl child. Partial withdrawal is also allowed for the purpose of education of the girl child. So at the age of 18 and after the age of 22, you can withdraw the money at the various stages and point of time for financing the graduation and post-graduation expenses of the girl child and making their life more financially secure. It is also going to give the tax saving advantages to the parent of the girl child. That means the account holders who have opened the account in the name of their girl child for investing into this particular scheme, they can also claim a deduction under section 80C of the Income Tax Act. So up to an amount of 1,50,000 maximum, they can ask for deduction for contributing their money into the scheme. It is a safe investment option, as we have discussed that there is a guaranteed return promise from this scheme of the post offices. So in such cases, obviously your investment will always remain safe in this financial instrument. So those who do not want to take risk into the investment procedure, they can take it as a suitable option for the purpose of investing their money and also earning a regular source of income. After that, it gives you a high interest rate if you will compare it with the other investment avenues of the similar category. Suppose that if you are investing your money into the saving bank account, then you will get a very nominal rate of percentage of return from that particular money deposited. But if you invest your money into Sukanya Samriddhi Yojana account, the interest that you will get will be comparatively higher from all these FD account as well as the saving bank account of the banking companies. Next one is gives you a chance of affordable premium or affordable contribution into the scheme. So the investors who want to invest their money into the Sukanya Samriddhi Yojana, they need not to have a huge lump sum financial amount for investing into the yojana. They can invest with the help of an annuity system by paying monthly installment into the scheme. You can pay up to 12 installment in a year for investing into the account. You can minimum invest 500 rupees as well as a maximum ceiling of 1,50,000 is also allowed under the scheme. Now, let us understand the various other eligibilities for opening the account. So, the first eligibility is that the parent or the legal guardian of the girl child can open this account any time before she turns 10 years old, and once the girl child is older than 10 years, a new account cannot be opened under this scheme. So, you can maximum open the account at the age of 10 years of your girl child. So, you need to consider this point very carefully, that you need to open the account before your girl child 10 years of age. The minimum deposit in this particular account is 250 rupees per year, and the maximum amount of investment that can be done is 1.5 lakh rupees per year in the Sukanya Samriddhi Yojana. The maturity period in the Sukanya Samriddhi Yojana is of 21 years from the date of account opening. That means in whatever age, suppose that if you have opened the account in the age of 5 years of your girl child, then from 5 to 21 years will be the maturity period of your Sukanya Samriddhi Yojana account for your child. Or it can also be matured after the girl child turns 18. That means if she gets married before the completion of 21 years, then also the maturity of the account can be done. So that means the maturity period of the Sukanya Samriddhi Yojana is dependent on the age of the girl child for whom the account has been opened, as well as it has a maximum time period of 21 years for the maturity. Now, let us understand the tax benefits that Sukanya Samriddhi Yojana gives you. So, the interest that is earned under the Sukanya Samriddhi Yojana is completely tax free for the account holder under the section 10 of the Income Tax Act 1961. So, whatever returns or income you may have from the opening of your account into the Sukanya Samriddhi Yojana is tax free, and that is how it also helps you to increase your savings. The contributions of up to rupees 1.5 lakh per year may be eligible for the tax deduction under the section 80C. That means if you do not have any other investment under the section 80C and you have opened a Sukanya Samriddhi Yojana and you are contributing 1.5 lakh rupees per year, then you can also ask a deduction of a maximum amount of 1.5 lakh for opening and contributing your account into this yojana. Then the amount that is received at maturity, that is also fully exempted from the taxes. The amount that is given at the maturity is used for the purpose of education and marriage of the girl child, and that is why the government has announced the income as the fully tax exempt income for the account holder. So these are the very important tax benefit that the account holder may get by investing their money into the Sukanya Samriddhi Yojana. Now, let us understand who are the beneficiary of this particular yojana. Any girl child who is a resident Indian is eligible to be the beneficiary under the SSY Yojana account. That means from the time of opening of the account until the maturity or the closure of account, the girl child who are resident Indian, they can be the beneficiary of the Sukanya Samriddhi Yojana. Now, let us understand how it helps you to secure the future of your girl child. So, you can save for your girl child's educational as well as marriage expenses with the help of the Sukanya Samriddhi Yojana. It gives you attractive interest rate. That means the interest rates are comparatively higher as compared with the fixed deposit into the bank and the saving bank account. It also gives you the chance of having multiple types of tax benefits under the section 80C and under the section 10 of the Income Tax Act. So on the interest, on the maturity amount, as well as for the contributions made into this yojana, you do not need to pay any taxes, as well as the premature withdrawal is also not allowed. So it keeps your money invested for a longer period of time into the market, and hence it makes it much more beneficial for the girl child to secure their future by investing the money for a longer period of time. Here the minimum deposit amount is also very low, from 250 to 500 rupees. The minimum amount of the per year contributions can be made into the yojana as per the earning of the household. The investor can decide what amount they want to contribute into the scheme. Maximum deposit of rupees 1.5 lakh per year is allowed in the scheme, and it also helps you to get tax benefit of this particular scheme. Then eligibility is any girl child who is under the age of 10 years of age and she is a resident Indian. So these are the various benefits, or you can say the significance of the Sukanya Samriddhi Yojana that an account holder may have, and their girl child may get benefit of these schemes of the post office. Now let us understand the rate of interest. If we talk about the rate of interest of 8.2% per annum, that is the current rate of interest announced by the Government of India in the Sukanya Samriddhi Yojana, is allowed as the income on the investment of the account holder, and no interest is paid after the maturity period. That means if the account has completed 21 years from the date of the opening of the account or the closure date, that means if the girl child, she is married, in such cases the interest will not be further allowed to be credited in their account. The contribution period has also been fixed under this yojana. So only for the first 15 years from the date of account opening can be deposited into this account. After that, no further deposits are required to be made, but interest will continue to accrue to the account for the maturity period. So until the maturity or at the 21 years of the age of the girl child, the interest will be going to be credited to the account holder's account in the SSY Yojana. Now, we have discussed now the first one scheme of the post office schemes. Now let us understand the next category of saving scheme of the post office, that is the time deposit account of the National Saving Deposit Account that is opened by the post offices. So post office time deposit account is a kind of the account that is offered by the India Post, and it is more like similar to a bank fixed deposit account, and it allows the investors to deposit their surplus money and to earn interest on their investment. The interest rate in this particular account is determined by the Ministry of Finance, and it is also revised quarterly by the Finance Ministry. The interest is mostly influenced by the prevailing rate of the government security. So this scheme is also government backed schemes, and that is why the prevailing rate of government security may have an effect on the interest rate that is given under the post office time deposit account. Now let us understand the features of the post office time deposit account. The tenure that is offered is of 1, 2, 3 and 5 years. So you can open your account for a fixed time period of 1 year, 2 year, 3 year or a maximum of 5 year. So you can have different time spans as the maturity of your account. The interest rate that is offered under this scheme is 5.5% to 6.67% for different tenures. So suppose that if you open your account for only 1 year, then the interest rate will be 5.5%, and it may vary depending on the tenure of your account. It is a flexible kind of investment. That means it can be opened at any branch, and the branch of the account can also be transferred by the investor for their convenience. A minimum amount of investment of 1000 can also be done on a yearly basis into the account, and there is no upper limit of the investment into the time deposit account of the post offices. Then it also gives you tax benefits under section 80C on a 5-year deposit. So if you are depositing your account for the 5-year of tenure, then it gives you a chance of claiming the deduction under section 80C also. Premature withdrawals are allowed, but they are subject to cuts or penalties in the interest rate that is offered by the post offices, and you can also ask for loan against the deposits with this particular scheme of the post offices. So these are the various features of the post office time deposits. Now you can also open the various time deposit saving account in an individual or joint format. If it will be individual, then the account holder will be a single individual, whereas jointly there may be 3 individuals who can open the joint account. Multiple accounts can be opened without any restriction by a single holder of the account. Tenure option varies from 1 to 3 to 5 years. Withdrawal is not allowed for the first 6-month time period of the account, but after that the withdrawal is allowed, but there may be penalties imposed on the interest rate that is offered by the post office saving account rate. Now, what eligibilities one must have for opening their account under the post office time deposit account? So, they must be resident individual of India. Minors can also open the account under the guardianship of an adult. So, upon attaining the majority, they can submit the application to operate the account by themselves only, but before that they may be dependent on their guardian or their parent. So, on their behalf, their guardians and parent can open the account for the minors also. The non-resident Indians are not eligible to open the post office time deposit account. So, those who are only residents of this country can open this account. The minimum time deposit requirement in this case is 1000 rupees, as we have discussed. To open the account, the deposit must be in multiples of rupees 100, and any extra amount not in the multiples of 100 will not be refunded by the post office time deposit account. Now, let us understand who are the individuals or the assessees that those are restricted from opening the POTD account. So, the following groups such as institutional account holders cannot open the post office time deposit account. Trust funds, regimental funds and welfare funds can be also not allowed to open the account under the POTD scheme. Now, let us understand how to open a post office time deposit account. If you want to pursue it with the online mode, in such case you can very easily open the account with the help of the internet banking access. So, if you want to avail it with the online basis, then it becomes easier for you. First, you need to visit the Indian Post e-banking website. You need to log in by your user ID, registered user ID and a captcha code. After that, general services tabs are there, on which you need to click on service request. After that, you need to follow the on-screen instruction to initiate the time deposit account opening process. In offline mode, you can download the POTD application form. You can collect it from the nearest post office also. You need to submit the form, you need to complete the documentation process, and with a minimum amount of 1000 rupees, you need to submit your form for the purpose of opening the account. It gives you a tax benefit under section 80C, and the maximum limit of the tax benefit is 1.5 lakh per financial year. The documents that are required for opening the POTD account are SB3 form, which is the account opening form that can be downloaded from the website, or it can also be collected from a post office. Then SB13, that is a pay-in slip for depositing your minimum investment into the account, and a specimen signature slip to provide the authentication regarding your signature on the account. The applicable interest rate in case of the post office time deposits are, in the first year you can get 6.9% of the interest, in the second year it is 7.0, in the third year it is 7.1%, and in the fourth year the rate of interest from the 1st April 2025 to the 30th June 2025 is 7.5%. There can be extension in case of the maturity of the POTD account. So, upon maturity, if the account holder wants to extend the tenure by submitting their application of extension, then they can very easily extend their account maturity, and the account will earn interest at the same rate as on the day of maturity for the extended tenure also. You need to also nominate a person as your account nominee for the purpose of making it secure for your family members or financially dependent person to receive the money in the event of the account holder's demise. So, these are the various benefits and the significance of the time deposits account under the post office saving scheme. So, we have discussed two more financial investment avenues under which you can invest your money, and you can minimize your tax burden also, and you can secure your financial future. With this, we come to an end of this lecture. Thank you.